I would like to kick off the panel with a question to Florian. Florian, OBVIAM has invested over $500 million in private equity, $500 million in private equity across the world, over 70 countries, and has also invested a significant amount, almost half, I believe, when I see your website, in SME banks and financial institutions. So given your diverse presence across geographies and sectors, you probably have a lot of learning on value addition, which you can implement as an LP, in investee funds, and there are probably a lot of cross learnings, right? Can you apply these learnings across geographies? What about sectors? Florian, do you think value addition is very sector specific? Can you apply the learnings across sectors? Giving us some interesting examples.
Thanks, Shivani. And it's a pleasure to be on stage with you again. This is great. OBVIAM, we're, I guess, in a unique position because, we've invested in over 80 private equity funds across Africa, Asia, Latin America, and Central Eastern Europe. And we've deployed actually, significantly more than the 500 million on the website over the past 20 years. So we've had some opportunities to see kind of the good, the bad, the ugly, and the great across different markets. And, we've been invested in India since 1999, and we've done close to a dozen fund investments during that period. And I mean, there's some general themes that we see that are consistent across the board with the fund managers we work. And to be honest, as an LP, it's a learning process for yourself as well in terms of identifying who's really adding value and who's just doing the lip service, right? So your question about whether sector is a generalist fund. I think for us, at least when we work with fund managers, we're a little bit different than I think traditional LPs because we're considered an impact investor. So we're looking for the financial return, economic sustainability, but we're also looking for fund managers that are going to invest and are going to generate a positive development impact and adhere to environmental and social governance standards. We feel that there's no trade-off really between the two, and our track record shows that the high mid-teens IRRs. So our value add and what we expect our fund managers to provide a lot is at a minimum on the ESG and the impact side. So we work with our GPs in terms of providing them the resources and helping them with the training to be versed in environmental social standards. I mean, governance is usually a given. Most fund managers by default, what we expect and what we see, provide good governance. They understand that in terms of the corporate governance structure of the company, sitting on the board, setting up subcommittees. These are the basic features that we expect and we see across the board. But where we see it gets more interesting is in the sector funds, right? When you're dealing whether an education fund or an agriculture fund, or a healthcare fund, you start seeing that the GPs have specialist team members who have usually some operational background, who've worked in industry specifically in that sector. And not only do they bring those relationships of working in that space, but they understand the regulatory environment, they understand the operational environment of a lot of these type of companies. And that's where you see, I think, a little bit more succinctly the value add being provided. Where we have challenges with our, I think when you take a generalist SME growth capital fund manager, what kind of value add are they providing really to a fund besides the financial investment and sitting on the board? And from an LP's point of view, you could take the point of view and say, well, why do we care, right? At the end of the day, if you get your return, you get your return, and you shouldn't really care what the management fee is being used for, how many people are on the GP, and whether or not they're adding any value. But I guess we took a different tack by deciding to really focus for impactful investments, because we felt that if you work with fund managers who really provide that value add in terms of the ESG and in terms of targeting specifically for positive impact, you actually build healthier, more respected companies that generate actually higher exit returns, because the acquirers do, and we've seen several times across our portfolio, do want to pay a premium on these companies that have received that value addition in terms of the ESG. But definitely we see broadly some difference between the sectors versus generalist funds versus sector funds, and then also between the VC growth capital and late stage funds. And if we have time, I can talk about that as well.
Fantastic. Thanks, Florian. I'm going to bring Mohit into the conversation now. I think you touched upon some very interesting things about specialized funds versus generalist funds. And Mohit, that's a great segue for my question to you. Of course, ICICI Ventures is one of India's oldest fund managers with more than 5 billion AUM. What's very interesting is that you have a management across strategies, right? You have funds in private equity, real estate, infrastructure, special situations, and so on. And I'm going to pick one theme out of what Florian said, specialist versus generalist, and pick up one of your subsegments on infrastructure, Mohit. Mohit, infrastructure companies are large, promoters are often very established, very influential. And my question, candid question that the audience would love to hear is, a lot of times these promoters know it all, right? And you can only add value if the recipient is a little bit open-minded. So I thought I would ask you the question about talking about a situation where perhaps you had to add value despite the promoter not wanting it.
So thank you, Shivani. Very nice to be on this, on this panel. As you know, the history of infrastructure in India is pretty checkered. There are lots of winners, but there are a whole bunch of losers also, and a lot of capital has been lost. So when we started out at exactly the question that it was difficult to add value, with Indian entrepreneurs in the infra space, so we took a very differentiated investment strategy. So we said, instead of being a minority investor or being we should have control of our own destiny. And then we said, we are going to make only controlled investments. So to work towards that, what we did was we said, if you want to control your own destiny and you want to control your own investments, then being only a GP is not enough. You need to have a good partner. So that's how we got a good strategic partner, and the GP, that is us, and the partner got together, and we created a company called Research and Power, which buys distressed assets in the power space. So that's how we did it. Because of this particular problem of adding value to Indian promoters, we said we are not going to do that, and we will. So it's our own company, and then we will go ahead and kind of add value. Because we are both the strategic and us as sponsors, there's no problem. I think there's a complete alignment of kind of interest. So whether all the value addition that you're talking about, whether it's in cost efficiencies or kind of operational efficiencies or liquidity management, we are all completely kind of aligned to do. So that's what we did. We co-created a company and we control our own destiny.
Fantastic. That was very interesting. And Michael, I'm gonna bring you in now. Portfolio advisors plays a key role in the development of the PE market, in Asia. I believe that your Hong Kong Asia team has committed more than $1.5 billion to perhaps 100 Asia-focused primary funds. You also do secondary transactions. You also do co-investments. So just a question that sort of ties both, a thread that was brought up by Florian and then, addressed a little bit more by Mohit. How does an investee fund or company differentiate between value addition for the sake of value addition, Michael, or true value addition? And the other question that I have for you is on the co-investment side. Because oftentimes what might happen is if you have a co-investor with a very different agenda, your company may either take advantage of it or get completely confused. So how do you align yourself with your co-investor? Because you do a lot of co-investments, so that investee companies benefit the most. Any anecdotal examples would be very helpful.
Yeah, thanks, Shivani. Let me know if you can't hear me. I seem to be having some connection issues on this panel. So as you point out, we have been very active investing across Asia and in a similar manner in India as well. Historically deployed over $5 billion in Asia PE investments. And the bulk of our investment is actually investing in funds. And you're exactly right, to the point that Florian was making earlier, trying to differentiate how GPs generate returns for us to better predictability of future returns, and that's where really adding value is important. And I think 99% of the funds and GP that we meet today represent some form of value addition, and how do you actually differentiate. I think a lot of times the quality of the team and how the team is set up is going to be the key. And I think operation team is definitely a very popular setup these days. But who do you have on the operation team, and what have they done? How have they interacted with your portfolio companies in the past? Another key thing is also strategy, as Florian has pointed out. Your buyout is not really a key strategy in developing Asia. It is probably more prevalent in developed Asias like Japan, Australia, but not really a key strategy because the market is not at that stage yet. But still, you do have some situation where GPs are able to purchase control transaction. In some cases, even management buy in the strategy where you will be actively responsible for the 100 days plan, the operation growth, the cost cutting measures. The GP in those cases will be extremely hands on, and that's where we found GPs who have that experience globally. Some of the more global GPs that is active in the region will be able to bring in this skill set, given that they have been very, very experienced in executing this type of strategy across the group. And there are also different cases like the fire chat mentioned just now, where you can actually bring in different resources. It could be finding customers in the US, it could be sourcing better, lower cost material, raw material from another region. So that's where GP is really able to really add quantifiable value.
Brings me to the second part of this panel, and frankly to the topic du jour, which is lessons learned from COVID-19. At the risk of being cliched, I must say some of life's best lessons are learned at the worst times. And Florian, we know that you have a lot of experience in investing in financial institutions. Post COVID-19, what we saw in India was a lot of borrowers, especially SMEs, have seen their businesses vanish, and thereby impacting their ability to repay. And I'm drawing back to what Michael said in terms of perhaps organizing funds, for your investee companies and for the funds that you invest in Florian. I'm sure this must have been a pretty difficult and delicate time. Are there any lessons for fund managers that want to invest, perhaps in this sector or just more generally, for the last 12 months in terms of value addition?
Look, it's a good question. I mean, I come from the point of view there's opportunity in chaos, and now is probably a good time to have dry powder to invest, whether it be in India or in other parts of Asia. I mean, look, we have exposure. We're primarily a fund of funds, right? So we do mainly primaries, and we do have exposure to direct financial institutions across emerging markets. Primary issue loans. We do loans to banks in certain markets. Not in India directly. In India, we have exposure to the microfinance and financial institution space through a variety of funds. And look, and across the board, it's I have to say maybe we were prepared by our fund managers and by the management of these financial institutions a year ago in March and April that it would be devastating. It will be very difficult. That the companies will face significant challenges, which they have. But I think overall, what we saw at the end of last year, it wasn't as bad as we thought it was going to be. And obviously, it wasn't as bad because our fund managers and the management of the companies took the necessary steps to reduce costs, reduce exposure. But the lockdowns and the inability to collect on a lot of loans and to reissue loans has affected a lot of the financial institutions across our portfolio globally. But it probably wasn't as bad as we expected, and I think it wasn't as bad not only because of the fund managers and management, but because we as LPs worked with our funds and in cases with the financial institutions directly to say, okay, it can get this bad. There's going to be a liquidity crunch. They're going to probably need additional working lines of capital. What can we do as LPs to try and help you as a fund manager help your portfolio, or how can we help you management of this bank? So I think anyone who wants to really get into this space, look, build a good relationship with your LPs. Because if your LPs trust you and have confidence in you, when times get difficult, like last year and still now, you can have a very open dialogue with your LPs and say, look, I need some help in reducing or relieving some of the restrictions I have in my legal documentation to allow me to help my portfolio companies, for example. There's been a variety of situations where we've had to make amendments to the LPA just temporarily in terms of recycling provisions, in terms of providing short-term facilities. The fund can provide short-term facilities to the portfolio companies. And you can only do that as a GP if you have a really good relationship with your LPs, because a lot of LPs have a knee-jerk reaction in a crisis. Whoa, let's just pull back. Let's not overexpose ourselves. So when a fund manager comes and say, hey, I need that flexibility to provide a little bit more capital to my company on a short-term basis, or I need a little bit more flexibility to recycle some funding, if you don't have that relationship, it doesn't really work. So look, honestly, that's probably the one thing is build trust with your LPs. But to plan for this, some of our fund managers had planned for these worst case scenarios, had these downside scenarios in place. What do we do if there's an economic crisis? How do our portfolios react? And a lot of fund managers put in place, I think, good plans, last April, May, especially in cost reduction and really engaging with their entrepreneurs.
With that, I'm going to get on to Mohit. Mohit, I'm going to pick up one of the things you said in the earlier part of this panel, which is that previously infrastructure had a very checkered past. And in fact, that's what led you to think about the strategy of majority ownership and perhaps co-creating companies, if you will, right? And you're right. And I think for the audience here, one of the very challenging things that we faced in infrastructure in India is the massive cost overruns and delays. In fact, as I was pulling some data together for this panel, I saw that, I saw a news bite from ET pulling Statistics Ministry's latest April 2020 update. And apparently, Mohit, construction of everything in India, from roads to ports, are behind schedule by an average of 3.5 years, and with cost overruns of costs of 1,682 projects have shot up by combined 4 lakh crores over their life cycle. So, against that backdrop, it must have been surely challenging, during COVID. And how did you reprioritize initiatives to derive value from your portfolio companies? I would be very curious about the learnings that you got out of this. Are there solutions that have been derived that investors in infrastructure can implement to derive long-term value? Can we apply this to other sectors more generally?
So the question is in 2 parts. One is about the investment strategy and cost overruns, and the second is the value addition. So on the first part, at least the way we think about it is we don't do any greenfield projects. We only do brownfield projects, or we do projects who are in last mile, projects which have gone, but because they are stuck in the last mile because the sponsors ran out of funds or there was some other approvals pending. So we only do that. The acquisition that we also did, which is about $1 billion acquisition of a supercritical plant in Uttar Pradesh, again was a completed project, but it had faced huge cost and time overruns, and the cost had become unviable. So there was a bidding process, and we bid and we right-sized the debt, and we kind of came in. So we are not taking construction. So, but of course, after we come in, if there is any incremental capex to be done to improve efficiencies and stuff, that we would do. But we don't take, greenfield risk. The maximum time to completion for anything we go into, we don't want it to be more than about 24 months. That's the way we kind of look at it. Just in terms of value addition and all the COVID-related stuff, the key issues that we faced were twofold. One is, once you have a completed infrastructure project, then there are operational disruptions which should not happen in a COVID period. And second is liquidity. These are really, they suck up a lot of liquidity. These are really large mega projects and stuff like that. So on the liquidity front, because COVID had come in and we knew the DISCOM cash flows are going to be really tight, we had set up very large working capital lines which we could draw down, and we had flexibility to keep running the plant even though we were not getting any payments from the DISCOMs for a long time. And we had a good buffer which was available. This is because we knew how to deal with stress assets and what you need to do. In a stress asset, it's always good to have liquidity. So that came in really, kind of handy. On the operational side, we have a great partner in kind of Tata Power, who, it's a 100-year-old power company, so they know how to run power plants and stuff. So all the critical spares that you need very early in the COVID era, we went and got all the spares and we stocked them. That in case logistics becomes a problem and the movement becomes a problem, we should not get get stuck. So we had a good stock of kind of critical spares with us. So liquidity and spares. Within the plant, again, we have a huge plant. It's got 2,500 people who kind of work there. Again, a lot of very strong COVID protocols had to be put in place. We had made, teams which are all contained and which would not contaminate each other. So we didn't want, if COVID comes, it shouldn't go through the whole plant. So we had isolated teams, cross-functional teams, which would be, kind of working. So we have done that. And lastly, we also use this opportunity to digitize a lot of stuff, right? So we had additional SAP modules, we had RFID-based bulker movements. So a lot of digitization initiatives which were on the back burner, which were on hold, they were like fast track, for efficiency.
So Michael, would love to now turn the spotlight on you. What was portfolio advisors' communication to your investee funds and portfolio companies during COVID-19? Without sharing any names, if you could give us an example of a fund or a company that you believe handled the situation particularly well.
Yeah, sure. Because we have quite a bit of investment in China, and that's the first market that's being impacted. So I think back in February and early March, we were chatting quite extensively with our managers across the region, including in India, discussing what we are seeing. And I think as I concur with how what Florian and Mohit has been saying, liquidity is the key. Thankfully, in our portfolio in India, there isn't any distress situation. In one example, in Australia, we actually have a GP that raised a sidecar vehicle proactively, although at the end of the day, there's no requirement to utilize that. But that is the key issue or the key assets that you want to have as a backup in times of crisis where there's still a lot of uncertainty even today. And I think if you look at how our GPs is handling the situation, I think thankfully our GP has been very experienced in the past, have gone through other down cycles and other crises, and that really helps in handling this situation. So one example that we have specifically in India, even in cases where firstly, that half of the funds is actually not affected, and instead, as Florian has said, found a lot of opportunities in this environment because they are more consumer focused, more tech ready, and then therefore the revenue actually benefited and is actually higher than the pre-COVID level through this period. There's some, roughly 30% of the portfolio where there's some impact, mainly in the financial sector, where there's a period where we have a moratorium and you need some time to work out the actual impact to your loan book. But again, that has really emerged strongly, and now when we look at the October numbers, it's already back.
I think it was very, very interesting insights. Again, stay close to your management teams, inject liquidity at the right time, plan for it. And of course, Michael brought up the interesting point that in some cases, there have been tailwinds that have got accelerated because of COVID-19.